Welcome. This is Heather Knutson, HomeSphere's Director of Marketing. I want to welcome each of you to today's event presented by our partners at Morgan Stanley. They'll be presenting a 2015 outlook for the U.S. housing market. And HomeSphere has partnered with Morgan Stanley over the course of the past year on a residential home builder survey initiative, and you'll hear us touching on these results towards the end of today's presentation. If you're a builder in our network who has taken the time to participate, we want to thank you today. And if you've not been participating to date, we encourage you to do so in 2015. The results are exclusively offered to those participants, and as an added bonus, we give away an iPad mini to one randomly drawn participant each month. We know today's topic is of high interest as we welcome our over 500 registrants, and our guest presenter today is Ryan Gilbert. Ryan is an equity analyst in the research department at Morgan Stanley. Ryan has nearly 5 years of equity research experience and has been covering the home builder sector since 2012. Ryan earned his BA from George Washington University in economics. And just a quick mention and housekeeping item to be considered of everyone's schedules, we're forecasting this to be approximately a half-hour session today. As a final reminder, if you have any questions for Ryan, I encourage you to use the webinar chat feature, asking your question that will be covered at the end of the program, time permitting. And with that, I'm going to turn the presentation over to Ryan for today's core event. Ryan.
Thanks, Heather. Happy to be here. I'm excited to share Morgan Stanley's views of the 2015 housing environment to everyone. Just as a quick housekeeping item, please reference applicable disclosures at www.morganstanley.com/researchdisclosures. So jumping right into it, our 2015 housing outlook is derived from our fixed income housing strategist research team and our economics research team. And the fixed income team is forecast estimates of supply and demand, which incorporates a range of factors such as household formations, shadow inventory, delinquency rates, and mortgage delinquency rates, as well as the autoregressive nature of home prices, which basically just means that if you're projecting out forward home prices, one of the best indicators is how they had previously been performing. So our 2015 forecast is really predicated on our expectation that we'll hit 1 million housing formations by the end of the year. So about a significant ramp from 2013 formations of 500K and well below what we've seen so far in 2014. We're expecting home price appreciation of 4 to 6%, new home sales of 500 to 550K, which would be a 16 to 27% increase from 2014, but really still well below the long-term average of 660K that we've seen over the past 30 or 40 years. Total housing starts of 1.2 to 1.3 million, which is really driven by multifamily, which we expect to increase almost 50% in 2015, and we're projecting 700 to 750 single-family housing starts in 2015, which would be 8 to 17% growth from what we've seen thus far in what we saw from the numbers that have been reported from the census in 2014. So jumping right in, our estimates are driven by our expectation around household formations. So as you can see, since the financial crisis, we've been running well below the long-term rate of 1.2 million formations a year, which equates to around, if you assume that we should be operating at the long-term rate, that there's about 2.7 million missing formations currently in the economy, and those formations will come back at some point in time. And we think part of the way it comes back is through the millennial cohort, which is the largest age group right now in the population. They're approaching the prime household formation range of 30 to 35. There's a Federal Reserve survey that shows that hedge rates, which are heads of households, increase from 20% of the total population to 18 to 50% at age 30. So there's going to be so that represents a significant increase in formations from this younger cohort. However, the younger formations are usually renters, so most of the new demand, we think, will ultimately become renter households. So our 2015 home price appreciation forecast is a plus 4 to 6% base case. This is the Case-Shiller not seasonally adjusted national estimate. The 4 to 6% growth would be in 2015 would be essentially flat from current levels, which are at 4.6% as of October, and that was just released. So our drivers are going to be economic growth, household formations, as we said, and then the risks to our HPA forecast would be that housing is no longer as cheap as it was a couple years ago, constrained mortgage credit, and then a declining homeownership rate past our expectations. So the chart on the top left shows the home price index year-to-date performance. The national index was up 4.6% year over year. The 20-city composite was up 4.5%, and the 10-city composite was up 4.4%. So we've been increasing since the base of 2012, but we're still well below the peaks that we saw in 2006, and the 20-city composite is down 17% from the peak. And so the driver of continued home price appreciation in 2015 is going to be an expanding economy. We're forecasting 2.9% economic growth in 2015, which is an increase from levels seen in 2013 and 2014. A pickup in household formation, so that's the chart on the bottom left, which is what we saw a couple slides ago, but we've shown our 2015 estimate at the end is the gray bar at the very end, and so we're still not projected to hit the long-term average in 2015, but we think we're going to make a lot of progress. But how have we done so far in 2014? The answer is not great. So census estimates household formations quarterly, and then the yearly formations estimate is a 4-quarter average. So in the first quarter, we had there were negative formations, which has driven the year-to-date average to 108,000. So we're well below levels that we've seen even in 2012 and 2013. But we think that will either rebound in the fourth quarter or increase in 2015. And then the last driver of HPA is going to be reduction in shadow inventory. So our last estimate of shadow inventory, and just as a definition, shadow inventory is our delinquent mortgages, mortgages in foreclosure, and real estate owned that's not shown in the existing inventory pool. This is a drag on home prices, and we've seen a significant decrease in shadow inventory. We're down to around 3 million by our estimate, which is 63% below the peak of 8.4 million in 2010. So what are the risks to our HPA estimate? The first one is that housing is no longer as cheap as it used to be. So the chart on the top left shows you price to rent ratios nationally for new home prices and for existing home prices. So new home prices in 2013 and 2014 have actually increased beyond their long-term average of 19 times the average rental rate. And existing home prices are still a little below the long-term average of 16, but they're trending up. Mortgage credit constraints. So this is the chart on the top right is the MBA Mortgage Credit Availability Index, and what we've seen since the housing crisis is that we've basically been flatlining. So there really has been a lack of mortgage credit availability, similar to the extent that we saw pre-crisis. And then the bottom left shows our last risk, which is continued homeownership declines. We're forecasting a continued decrease in the homeownership rate to 64% by the end of 2015, which is down from almost 65% currently. So just to clarify this chart on the bottom left, what we're looking at in blue is the homeownership rate. So you saw a big increase from the 90s until 2006, and a very large reversal from 2006 to 2014 from the high of 69% in 2006, and you've seen a corresponding increase in the rentership rate. Our 2015 new home sales estimate is 500 to 550,000, so we're expecting growth to return after a slow 2014. We were at +2%, so the trailing 12-month new home sales growth rate as of November was +2% at 433K, and so we're forecasting that to turn around, which would be driven by an increase in inventory, moderating HPA, and mortgage payments relative to rent. And we note that we're still below the long-term average at 660K, and the high end of our estimate, 550,000, is well below is 8% below the long-term average. And then risks we see are as similar to our HPA risks, mortgage credit constraints, a declining homeownership rate, and then another interest rate shock or mortgage payment shock, which we saw in the second half of 2013 and throughout the first half of 2014. So our new home sales drivers, the chart on the top left shows you shows you the new home sales by year since 2000. So as you can see, we're currently running well below the historical average of 660K. We think that a primary driver of new home sales in 2015 is going to be an increase in inventory. We think that as inventory returns to the market, so will buyers, as there's actually product to go out and buy. So the chart on the right shows you the increase in inventories that have occurred since 2014. So we went from under 4 months of supply in 2013 to back to the long-term average months of supply, which is around 6 months for new home sales. But we note that we're still on a gross basis. The average inventory level is still below the long-term average. So the bottom left, we think that the industry trend will continue. These are new homes that are available for sale, so current inventory by stage of construction. So we're looking at completed inventory, which is blue, under construction and not started. And what you're seeing in this chart is that starting in 2012, we got a lift off in homes under construction. So we expect that trend to continue into 2015. Although we note that we're at 121,000 units currently under construction, which is below the long-term average of 500,000. And then the bottom right shows you moderating mortgage payments relative to rent. We calculated mortgage payments assuming using Zillow data per MSA, which is metropolitan area. We assumed a 20% down payment and a Freddie Mac conforming 30-year mortgage rate. And what we found, what you can see in the chart, is there's a big hump from May to really January of 2013 to January 2014, which is when we were seeing double-digit increases in HPA, and we had a 100 basis point spike in long-term interest rates. But that's moderated significantly throughout 2014. And mortgage payment growth rates relative to rent growth rates are basically flat heading into 2015. We think that the key risk is to our new home sales forecast would be another payment shock similar to the one that we saw in 2013 and 2014. So the chart on the top left shows you our estimate of national new home payments and national resale payments, which were up over 20% in October 2013, at October 2013, which was sort of the peak, but they've declined steadily throughout 2014 and into 2015. And the chart on the bottom left shows you our estimate of average mortgage payments by selected cities. and these are primary new home sales and home building markets. So going into January, home buyers were facing up to a 30% increase, looking at a 30% year-over-year increase in mortgage payments relative to January 2013. So we see 29% in Los Angeles, 29% in Miami, 30% in San Diego, but that rate has diminished significantly throughout the year. And so we think that as the growth rate of mortgage payments moderates, home buyers will get more comfortable with the current housing market. And then the last risk, again, is continued homeownership declines. If we see a drop in the homeownership rate below our estimate of 64% in 2015, I think that's going to be a headwind to our 500 to 550K estimate. So 2015 housing starts, we're forecasting total starts of 1.2 to 1.3 million, with single-family starts at 700 to 750K. So the growth rate here is really driven by multifamily, which we expect to be up 50%, and we're projecting single-family starts growth of 8 to 17%, and that's the chart on the left. What's interesting, if you look at the chart on the top left, is that we just hit a million housing starts on an annualized basis in the late part of 2014. We're still well below the long-term average of 1.5 million total starts, and the growth rate has really been driven by multifamily, which is approaching the long-term average of 435,000 units a year. They're at around they've been averaging around 400K so far this year, and single-family starts at an average of 640K is really around 40% below the long-term average. So we think that demographics are going to drive the increase in housing production. So the chart on the top right, shows you estimates for population growth by age cohort, which is from the Census Bureau. And what we're seeing in 2015 is that the 20 to 35-year-old age cohort is expected to increase by 6.3%, and the 35 to 54, which is really the prime home buyer cohort, is going to decrease by negative 2.7%, and that trend continues throughout 2020 until we get out into 2030, when we see a turnaround in the 35 to 54 home buyer segment, which is really the millennial cohort hitting that age bracket. So in light of our view that most new and the census's view that most of the population growth is going to come from the millennial cohort, we're expecting most of the new formations to be from that cohort as well. And those the homeownership rate for people aged under 35 is under 40% versus 70% for 35 and above. So we think that most of these formations are going to be renters. But single-family starts should benefit. We think, again, from low supply, you're seeing the gross amount below long-term averages. And the data that we're seeing from public builders is beginning to reflect that. So the bottom left shows you lots owned and controlled inventory by the public builders in our coverage. Or not in our coverage, total public builders. They were up, lots owned and controlled were up 20% in 2013, and they're up 4% year to date, so moderating from the big jump that we saw in 2013. But still a large increase. And similarly, we're seeing a steady increase in community count growth, up 9% in 3Q14 from negative 1% in 1Q13. So we think that there's an opportunity, and builders are recognizing that. Hence why they're increasing lots in community count. Okay, and then finally, our 2015 existing home sales estimate, we're looking for 5 to 5.25 million, which is a 2 to 7% increase from the levels we saw as of November, which were 4.9 million, which in turn was down at 3.5% year over year. So we're expecting a modest improvement from 2014 levels. The decline in distressed sales, we think, has been the primary contributor to negative growth in existing home sales in 2014. The chart on the right shows you distressed sales by region and also nationally, although the national line is the blue dotted one that's a little hard to tell from the regional distressed sales levels. So nationally, distressed sales are down to 13% in October from a peak of almost 40% in 2009. So those buyers are exiting the market. The buyers in distressed sales are exiting the market, and the increase is going to be in 2015 is going to be a transition to your more traditional home buyer. The mortgage credit remains a constraint for them. So these charts are relatively technical, but what we're looking at is our conforming purchase mortgages by FICO score buckets. So these are mortgages that are sold to Fannie Mae and Freddie Mac. And what you can see is that loans below a 700 FICO score used to be around close to 30% of the market, but are now almost 10%. So big decline in the lower bracket FICO scores, and in fact, the percent of loans that have a FICO score of less than 620 is basically non-existent. And we're seeing the same sort of trend in FHA purchase mortgages as well, which are lower down payment and target first-time home buyers. All right, so having gone through our 2015 housing outlook, we wanted to share the results of the Morgan Stanley HomeSphere survey of home builders, which we've been conducting since January of 2014. So we've got a year's worth of data, and we wanted to share the results that we found since we started the survey. And what we found really is that the volume growth outlook going into 2015 is positive, but the margin outlook is not as positive. And the 2014 trends have been increased new home sales volume levels, a softening margin outlook, labor and material costs remain a top concern, and the new home buyer has jumped as a concern for builders. So these are the survey results, and what we're looking at here are new home sales year over year, and then prospective traffic year over year. So throughout the year, we saw an increase from January to May, followed by a flat percentage of builders reporting higher new home sales year over year, and then we saw a decline from above 50% of builders reporting up or higher new home sales on a year-over-year basis to the low 40s. But that trend reversed in October and November after bottoming in September. And in fact, we're seeing builders reporting higher new home sales year over year increase to above 50% for the first time since August. What we think is interesting about this chart is that we're surveying builders on their year over year increases or decreases in new home sales. So it should to some extent control for seasonality or the seasonal nature of new home sales. But instead, what we're seeing in the year-over-year results is what looks like a seasonal pattern where we're seeing an increase in builders reporting higher new home sales on a year-over-year basis into the spring selling season of March through May and into the summer, and then decreasing in the seasonally slower parts of the year. So if this is something that we're going to be watching closely in 2015 to determine whether it's a trend. So traffic. So after an encouraging turnaround in new home sales, we're seeing a downward trend of builders reporting higher traffic levels continuing throughout 2014. So we're down to 43% from builders reporting higher traffic levels from a high of 68% in May. Although it is worth noting that the up bracket, so the percent of builders reporting higher traffic levels, is losing market share to builders reporting flat traffic levels rather than down. Down has been builders reporting down traffic levels has been relatively flat throughout 2014. So the next result is sequential changes or month-over-month changes in prices and incentives. So this definitely, this is a month-over-month survey question, so there's definitely seasonality in this data. We're seeing builders reporting pricing increasing, trended up into the spring selling season before trending back down to the low 30s at the tail end of the year. And the trend in October through December has been relatively flat. New home sales incentives, so these are the percent of builders who are reporting an increased use of incentives, flat use of incentives, or a decline in incentives, has been, for the most part, flat, but we are seeing, interestingly, we saw a tick up in February through May, which we think was used in part to stimulate anemic demand, which in some way related to a cold winter and maybe a slower spring selling season than we had initially thought. And then another tick up in September through November, which mirrors commentary that we've been hearing from the public builders. Incentives did tick down in December to 17% of builders reporting higher incentives from 26% in November, which we think is likely seasonality as we're entering a seasonally slow period. So our next slide is cost trends. So what have we seen in labor, materials, and lot costs? So the material and labor has been the percent of builders reporting higher than 5% material and labor cost increases month over month has been declining steadily throughout the year, which is a positive for builders. It's moderated from the mid-teens in February and March down to 10% in December. And so just to reiterate, this is a month-over-month number. So there's definitely seasonality, and part of this deceleration into the end of in builders reporting cost increases throughout the end of the towards the end of the year is potentially just seasonality. So finished lot costs, we've seen builders reporting of lot costs has been trending in the last part of the year towards flat, which is moving from builders reporting higher lot costs. We saw a big increase in builders reporting flat finished lot costs on a sequential basis in December when it hit 69%, which was the highest that we've seen since we began looking at this survey. And we're looking at, and the chart below shows undeveloped lot costs, which has shown a similar trend. And again, this is month over month, so there's likely some seasonality in here, but we're going to be interested in following this trend into 2015. So now our outlook, looking into 2015, what are we seeing? We're seeing an improvement throughout the end of the year in the new home sales outlook, with builders steadily reporting increases, steadily reporting that they expect new home sales to be higher in the next several months. Just as a housekeeping item, we changed the survey question in December from where do you think new home sales will trend in the next 3 months to next 6 months, which we think gives us a little bit of a better view into the year and builder outlook. So 75% of builders thought that new home sales were going to increase in December, in the next 6 months in December, which has been steadily increasing from a low of 55% in October. The chart on the right shows you the current ending, is our question about the current ending of the housing recovery. So it's a gauge of where builders think that we are in the housing cycle, and the very clear trend throughout 2014 has been builders shifting from thinking that we're in the early stages or the early innings of the housing recovery to the middle and late innings. And we saw a reversal in November when builders shifted from middle innings to early innings. That's the 18% you see in the November 2014 column, but that trend reversed going into December back down to 11%, which is still the highest level that we've seen since August. We think that part of this trend is driven by some pessimism around the new home sales environment in 2013, which has been, as we noted earlier, has been stagnant from 2013. So new home sales in 2014, as a reminder, are up 2% so far in November, from compared to plus 21% at the end of 2013. So survey results, pricing outlook. This is an encouraging trend. We're seeing builders increasingly shifting to expectations around higher prices throughout the year after moderating from January to July. And then incentives have also trended higher. So builders reporting higher incentives was 25% in December, which is over double the amount that reported higher incentives in January of 2014, although the majority of builders remain in the flat bucket. And this outlook on incentives mirrors some of the commentary that we've heard from public builders about the increased use of incentives throughout the year. So as positive as our price outlook is, the materials and the cost outlook is somewhat of a damper. 80% of builders are reporting higher labor and material costs in the next 6 months. And 73% of builders expect finished lot costs to be higher in the next 6 months, which has been increasing into the end of the year. Undeveloped lot costs, so raw lots, has been relatively flat throughout the year, so there's not too much of a change in the trend of builders reporting, for the most part, higher undeveloped lot costs. So we thought we'd end on a bright spot with 2015 top concerns and how it's changed from 2014 top concerns, and then just a chart on the buyer segment that we thought was strongest. So 2015 top concerns, not a surprise, rising cost of building materials and land and labor are at the top. It's interesting, we had seen in the end of 2014 the rising cost of building materials was declining as an end-of-year concern, but it's jumped back up going into 2015. What we also thought was interesting was the increase in builders who were concerned about the lack of the first-time home buyer, which is the second to bottom concern on the chart on the left, as well as the third to bottom concern on the chart on the right. So it increased in November, and it stayed at relatively high levels, around 20%. So it increased to 30% in November before jumping back down to around 25%. But we think that just reflects increased concern about mortgage credit availability and the inability of first-time home buyers to get back in the market. Although the buyer segment rated strongest has been trending slowly upward in the past 2 months towards the first-time home buyer, which is that light blue line at the bottom. So in November it was below 20%, but in December it's jumped above 20%. So that'll be an interesting trend to watch into 2015 if we can see an increase in the first-time buyer. And I think that that concludes my review of the HomeSphere survey and the Morgan Stanley 2015 housing outlook. Heather, back to you, and I'd be happy to take a couple questions.
Thanks, Ryan. That's a terrific presentation, and you guys were very gracious in the amount of information that you shared with our network today. So I do have a couple questions that came in for you, and we'll cover those here momentarily. But thank you so much. And as we gear up for next week's International Builders Show, this is great food for thought. Be sure. HomeSphere is going to be at the International Builders Show next week with our sales force, and I believe Ryan, you guys have a few people from Morgan Stanley attending as well. So if anyone on today's call would like to potentially connect with Ryan's team or my team from HomeSphere, please send me a private message after this event. My contact information was shared on the reminder email that went out to everyone earlier and is hknutson@homesphere.com, hknutson@homesphere.com. And a few questions, Ryan, starting with this. How do you see the falling oil prices affecting starts? The oil patch has been good for starts for so long.
You know, it's interesting. It's that has been increasing as a concern. As of right now, we're not forecasting a really significant impact from oil. But I think and part of that is due to in Texas, we think that builders which would be the primary state affected by a decline in oil prices. There hasn't been a decrease in demand yet, but there has been somewhat of a decrease in housing activity from what we've heard from the publics. So it's not in our estimate, but it's not in our forecast, but it would certainly be a headwind if it significantly impacted the Texas economy.
I appreciate you answering that, and I'll tell you we just had 4 requests for a copy of your PowerPoint presentation, so definitely some good information. Ryan and I are unable to actually share the slide deck today. However, we are recording this event, and so for anybody who's attending today's event, you're going to receive an email with the location of where to find that recorded presentation. That will be uploaded Monday the 19th by end of business, and that is under the video section at homesphere.com. So just a reminder there, and we appreciate those requests and hope that you'll be able to re-review that recorded version. So just taking the time to answer that since we did have several inquiries come in. And then one last question, and if anybody else, we have a few extra minutes, so if you want to use the chat feature to ask a question, feel free to do so. You talked a lot about the multifamily emphasis and the trend there and how that's related to starts. Can you give kind of a little bit of a prediction on what your team will expect to see differently at the International Builders Show pertaining to that multifamily emphasis? Is that something we're going to see covered there, or kind of what is your outlook for our builders who will be attending next week?
I don't think that we are going to have an update of our estimates around multifamily formations and starts as of next week. I think this is our forecast, and we wouldn't expect revisions for at least several months. We still have to wait. Part of it is we still haven't received starts and formations data yet from the census.
Okay, we'll stay tuned for that, and I'll make sure I share with you what we see pertaining to multifamily when we're in Las Vegas next week for sure. And just a reminder there, that, for those of you that are asking for access to this information, any of the builders who are participating, they are getting exclusive access to some of this data. So this is just another reminder of how important it is. And I think both Ryan and I would say each survey is reviewed and each survey is incorporated into this feedback. So just a reminder there. A couple more questions here, and then we'll wrap up here at about 12:45. What is your outlook for the California market specifically?
California market, we don't have a national, or our forecasts are really national. California, what's been interesting was they were one of the states that were hardest hit by price increases in 2013 and 2014, and which clearly has impacted demand. Again, we're seeing a deceleration in mortgage payments in California, but not to the extent that we've seen in other states. So we think that the overall rate could be muted relative to our national estimate.
Very good. And wondering if you're able to answer this question, let me know if you're taking it to the level of square footage. And with square footage, is square footage of starts decreasing or increasing?
I can't. We're not forecasting to the square footage level, unfortunately.
Yeah, I didn't think we're taking it to that level. Wanted to ask that question that came in from Randy King. Randy's asking some great questions today. Ryan, that wraps up the questions that have come in so far. I really appreciate your time today and want to thank you and the Morgan Stanley team. We appreciate your partnership with HomeSphere. I want to thank everyone for attending and take a moment to remind you to like HomeSphere on Facebook to stay tuned for future webinars and event opportunities throughout the year. If you're a builder and you'd like to connect with us to learn more about connecting and collecting rebates or participating in future surveys, please reach out to me directly. And as a last reminder, the recorded version of today's presentation will be uploaded to our website by the end of the day, Monday the 19th. Appreciate everybody's inquiries on that. And if you're attending the International Builder Show in Vegas, reach out. We'd love to meet with you if possible. Stay tuned for future webinars offered by HomeSphere throughout the year. Wishing all attendees a profitable